As a limited partner in real estate syndication, you should expect to be extending your tax return, your individual tax return, beyond the 415 deadline. I've been investing as a limited partner for the last almost 10 years now, and I've extended all of my tax returns because inevitably one sponsor or another is not going to give you the K-1s in time to do it. And that's the nature of this game. And
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?
Hi everyone, I'm Jason Balara, and this is the Know Your Why podcast. Today I'm here with Thomas Castelli. Thomas is a tax strategist and real estate investor, and he helps other real estate investors keep more of their hard-earned dollars in their pockets. Interestingly, and maybe we'll just a little plug here, you have grown your podcast to 4 million plus listeners, the Tax Smart REI podcast, and just as a personal listener of that podcast, anyone who has real estate tax-related real estate questions, maybe not just real estate, but it's a great podcast, well presented and easy to digest. So thanks for coming on the show today. I'm super excited to talk.
I'm excited to be here. Thanks for having me. Appreciate the kind words on the Tax Smart REI podcast.
Yeah, absolutely. Would you just start with kind of telling us your background, a little bit about yourself, how you got to where you are today, and then we'll dive into some I think relevant tax topics as we met today. This won't come out today, but we are recording this on April 15th, tax day. So it's kind of a funny coincidence.
Yes, it is. So absolutely. So my background, I basically, long story short, went to college for business management and accounting. It was kind of something that my parents pushed me towards, and my guidance counselors, if you will, at the time said, look, if you're going to be going into school for business, you want to do accounting or finance or both, because those are the degrees that are really going to get you somewhere. That's what I was told. So at the time, being a young guy, I said, okay, let's do it. So probably about my sophomore year in college, I came across a Rich Dad Poor Dad book, and really sparked my interest in reading and self-education. And I realized that there was a common theme with people who build wealth, and I realized it was real estate. So I said, okay, well, how can I go about getting myself involved in real estate? So long story short, what ended up happening is my great uncle, he was 99, he had passed away, and he had a small house on a relatively large plot of land. It was on a normal suburban side street, but it happened to be a 5-minute walk to the Long Island Railroad, which goes right into Penn Station. So I realized, I'm like, that's an ideal. And then around it had all shopping centers within walking distance and stuff, everything you would need. And I was like, okay, great. This is like prime real estate. We should do something with this. Like, we shouldn't just let it go and slip through our fingers. So I went to a Long Island real estate investing meetup, or a realtor meeting. And long story short, never got a chance to do anything with that property, but the people who bought it put up 3 houses on it. So good for them. But at that meetup, I learned about real estate syndication and a group that was doing an event on real estate syndication. So I went to that 3-day weekend, fell in love with the model of syndication, and started investing as a limited partner with some of my mentors within that group. Eventually syndicated an 82-unit apartment complex that since went full cycle. We sold it during COVID. That was a whole story in of itself. But long story short, that's kind of my investing experience. And then around the same time we did that deal in that 82-unit apartment complex, I said, you know what, how can I marry my tax background with my passion for real estate? And that's when I joined the Real Estate CPA, or Hall CPA, as we also go by, as a tax strategist, and get to help people reduce taxes. So that's, like, in a nutshell, my story.
It's really cool and interesting. You mentioned that that piece of land, that it is really true. Like that, a lot of people kind of get into real estate almost accidentally. Something that just happens, kind of falls into your life, and then kind of realize, okay, this could be a good thing. How do I figure out something to do with it?
Exactly.
And so you syndicated before joining Hall CPA. So you kind of, it's an interesting. But you were already a CPA, right? Just so I'm.
Yeah, so I was a CPA I was in general assurance at a national accounting firm, doing like audits of private and publicly held companies. And we actually closed on that syndication deal in November 2017, which was the same month that I joined Hall CPA, but the deal closed first. So I was that was in motion, and then I joined the firm like later on that month, and the two weren't related like necessarily, like it just happened to be in that same time frame. So
Yeah. Okay. So, so you've kind of been on both sides of the coin of, helping investors and being an investor. I always think it's interesting when I talk to people that are in kind of the support industries for real estate, and especially uh, especially the brokers. I'm like, why are you not buying these properties? Like why are you not doing it, kind of thing. But you have done it, so you've kind of seen it from both sides, which is a really cool perspective. When you one of the big, and I mentioned this before we started recording, and I guess I'll just dive in with this question, is one of the big things that comes up for me from my investors is, they're asking, when's my K1 going to be there, that kind of thing. So obviously we're trying to meet those tax deadlines. People should know that they can get an extension. They don't, it's like there are workarounds for the actual dates. But I wanted to talk about what it means when we people talk about the tax benefits of real estate. I think it's a really a different thing if you're talking about an active investor versus a passive investor. And I wanted to see maybe if you would, kind of give us at least some high level information on that.
yeah, absolutely. So I'm going to break it down. I could break this down maybe like 2 or 3 minutes on how this all works, right? So when you have income from a job or a business, that's typically called earned income. This can be taxed up at rates up to 37% at the federal level. Then you have state taxes, you have FICA taxes or self-employment taxes. When this all adds up, you could be easily paying, if you're a high income earner, and I've seen this happen plenty of times, especially in New York and California, where I'm from New York. But where we see it is like it's easy to see high income earners paying 40 to 50% of their income in taxes, and it's painful to watch. However, with rental real estate, there's a non-cash expense called depreciation, which shelters your income from tax, despite the fact that you might actually be generating positive cash flow. So if I'm going to let me just give a quick example of this. You say you're in the 30, you're in the top tax bracket, right? If you earn another $100,000 in wages, or say let's call it $55,000 to keep things simple, and say you were paying 40% all in on your taxes when all is said and done, you're going to pay $22,000 in taxes on that $55,000, right? But now let's take a rental property. It could be a passive investment from like a syndication, or it could be a rental property that you own. Either way, the concept's still going to be the same. Let's say you have $100,000 in rental income. Then you have $4,500, $45,000 or 45% expense ratio in actual expenses that you have to pay third parties to operate that property, property taxes, property management fees, utilities, maintenance, all that good stuff, right? Mortgage interest. You're going to be left with $55,000 in quote unquote net income or cash flow, right? In most businesses, you're going to pay on that $55,000, you're going to pay taxes. So again, if you generated that from that $55,000 from a business, you might pay $22,000 in taxes. However, there's the non-cash expense called depreciation, and in this example, let's just say it's $60,000, right? So now you have a tax loss. So you're telling the IRS, hey, I lost $5,000, right? But yet you generate $55,000 in cash flow, right? Tax free. So in one scenario, you earned extra money from your W-2 job or perhaps a business, and you paid $22,000 on it. The other example, you earned $55,000 in cash flow, right? Money you put into your pocket through real estate, but you paid zero taxes on it. So that's the power of rental real estate. And this is exactly how it works for limited partners, and why rental real estate is so powerful. One of the many reasons why.
And yeah, I mean, depreciation is a kind of amazing thing to once you kind of figure out how to use it. This is my understanding, but please clarify. There's something called real estate professional status.
Right.
And that is, in my understanding, allows you to use some of your passive losses against your active income, if you have real estate professional status. So would you talk a little bit about what real estate professional status is first, and then I have a follow-up question?
Yeah, absolutely. So, all rental activities are passive by default under the tax code. This has been this way since the Tax Reform Act of 1986. And what that means is that your passive losses can only offset other passive income or gains from the sale of your passive income activities, such as rental real estate. What the real estate professional status allows you to do is turn those losses non-passive, and then those losses can offset your W-2 or your active business income. So, for example, that $5,000 loss that you're telling the IRS that you have, if you're a limited partner or you're a passive investor, that can offset other rental income that you might be generating, or perhaps the gain on sale of a property or syndicate that you have. And these losses could be much larger than 5,000. In fact, in many cases, they are. But let's just say that it's 5,000 for the sake of example. As a limited partner, that's either going to offset other passive income or be suspended and carried forward to future years, which you can use it to offset passive income or gains. Now, with the real estate professional status, you'd be able to deduct that $5,000 against your earned income, say income from a job or a business. So that's what the real estate professional status allows you to do.
Yeah, and the way I've thought of it, to simplify it for myself, is it's like the real estate professional status allows you to use it now versus
Right.
if you don't have real estate professional status, it doesn't mean you lose it. You
Exactly.
just don't get to use it until you have some sort of passive income, some positive passive income coming in. So, as you mentioned, whether that's from a rental income or the sale of a property. So I think, because one of the questions, it's tax time. One of the questions I've had from investors, like can I file? I'm waiting for my K1. It might not be in yet. Sometimes we don't get our K1s back in time for the official tax deadline. What do you recommend for people that suppose they don't have real estate professional status, but they have invested passively? They're limited partners, and they're expecting a K1. Like, can they just go ahead and file and like put that on next year, or how does that, if they don't expect to have a big loss generated by that?
Yeah, that's a great question. So to clarify the questions is do you need to file the K1 if you expect a loss? So here's how this would work, right? So as a limited partner in real estate syndication, you should expect to be extending your tax return, your individual tax return, beyond the 415 deadline. I've been investing as a limited partner for the last almost 10 years now, and I've extended all of my tax returns because inevitably one sponsor or another is not going to give you the K1s in time to do it. And that's the nature of this game. And this is something that comes with the territory, getting all those K1s out, especially if you have a big sponsorship team that has hundreds of investors, that there's a lot that goes into that. So that's just the first thing I want to point out there, is that you should expect to extend your tax return. Now, as for like, do you need to file the K1? If you have a loss, technically you may not actually need to file the K1. However, I would strongly recommend filing that K1 so you take the losses with you, right? The losses do carry forward, and you will eventually use it against future rental income, or if not, then almost certainly on the gain on sale, assuming the investment is a successful investment, which you hope it would be, right? So to answer the question, you do need to file. It would be strongly recommended to file the K1 on the tax return. What most of our clients would do in that situation is you maybe have your CPA prep your tax return without the K1s, and you have an idea of like, do you owe money in taxes, so on and so forth, or they can even estimate what those K1s will be. Sometimes syndicators will give you an estimated numbers for your taxes in some cases, and then file your return once you have all the K1s. So you have until October 15th to file your individual return. So that's kind of in a nutshell what my recommendation or what my suggestion would be.
Yeah. And that's what and I think it's just, you sometimes have people that might be new to passive investing
Right.
and being a part of syndication, and they're used to, oh, my tax return goes in on, this day every day, or this, by this time every year. And they may also, I think a lot of instances, maybe they're expecting a return, and so they don't want to delay it. But we always do suggest just file the extension. We get them to you as quick as we can. But as you mentioned, there's just a lot of extenuating circumstances in, particularly like, for example, we have a fund which has multiple deals within it. So the K1s have to come from the multiple deal in the fund and then go and then be divided up amongst the investors in the fund. So there's layers of it that aren't necessarily part of, sort of your normal, if you will, tax filings, if you have just a W-2 job.
Right.
So when someone is a limited partner, they have a W-2 job, they maybe don't have any other rental income outside of this. So that those depreciation losses are essentially just kind of banked until, sale comes. Is that's the idea? Is it's just sitting there?
Yeah, you're banking those, and in fact, that's actually a big strategy of a lot of LPs. Well, not at least in my experiences, what they'll do is sometimes they'll actually make because of bonus depreciation, right? Bonus depreciation was at 100% through 2022, but now it's kind of phasing down 20% each year under current law. At 60% this year, next year will be 40%. The following year will be 20%. What a lot of people will do is they'll invest in properties or invest as an LP in deals today. Of course, that makes sense from an investment perspective, to get those passive losses today while bonus depreciation is high. Let it sit on their return until properties sell. So that's known as passive loss banking, or some people would even call it a laddering strategy, where you kind of invest over time and you bank those passive losses. But one thing I will say on this is that, yes, they will probably be used at sale. But what you could do is you can go and invest in other LP opportunities, perhaps that would be more cash flow heavy, maybe a business or maybe just another rental property or syndicate that's going to be more cash flow. And you can actually use those passive losses before that to shelter that income. And we've seen that too. So.
Yeah. And that's actually a great point, is that, it doesn't necessarily have to wait until the sale of that specific property. It just needs to wait until you have actual income coming from passive activities. So exactly. It can kind of marry up to that. Yeah, it's a really cool, and I think what you mentioned there about that sort of ladder, what the idea is, if you're investing, you're probably not just investing in one single deal. The idea is to kind of build that snowball over time, and so you get in multiple deals, and then those tax strategies go along with adding in multiple deals. And I know people will, if they think they're going to have a big tax bill one year, then they're going to specifically go out and look for deals that have a lot of depreciation to them, so that they can invest in that and offset that tax bill. There's just a whole lot of strategy that goes into it once you start getting into that space.
Yeah, absolutely. And what you just referred to, investing in another syndicate when you expect one to sell in that same year, is people have dubbed it the lazy 1031 exchange, because it gives you kind of effectively the same benefits of a 1031 exchange, but without like having to actually formally go through
all the pressure.
Yeah, 45 days, 180 days, all that.
Right. Yeah. It is one of the things. I mean, because I when I started investing, I started as a passive, and I had W-2 job, and it was just, this has been kind of a fascinating topic for me to like try and figure out the ins and outs and how it applies to me, because a lot of my investors would have the same questions, and a lot of this I learned from your podcast, so thank you. The other, I guess, loophole, if you will, that people talk a lot about is the short-term rental loophole, which is again another, it's a different real estate strategy with a different set of tax implications. But I'd wondered if you would just kind of describe that as well for people.
Yeah, absolutely. So to make this make more sense, we'll go back to the real estate professional status real quick. So real estate professional status turns your losses on your rental activities non-passive and can offset your earned income and other non-passive income. However, to qualify, you need to spend more than 750 hours, which is roughly about 15 hours per week on average, and then more than half of your total working time. And for most people who have a W-2 job, or perhaps in a couple where both spouses have a W-2 job, it's challenging, if not flat out really impossible, is proven by IRS audits and tax court, to actually qualify as a real estate professional under those circumstances. However, the short-term rental loophole, it's referred to, and the reason why it's referred to a loophole is because it allows you to take losses on an ordinary property, say this house right next door to me, it's a single family house, as non-passive, and it's a way around the passive activity rules in a sense. But the reality is it's not really a loophole, because these rules were designed back in the 80s, along with everything we're discussing here today, for hotels and motels. So the way that it works, and presumably though, Congress didn't foresee Airbnb and VRBO coming back in the 80s. But so the way that it works is that if you have a property that has an average period of customer use of 7 days or less, or 30 days or less, and you're providing quote unquote substantial services, which are really hotel-like services you'd find at a hotel, like daily cleaning, daily meals, concierge, things of that nature. If you're meeting one of those two criteria, you're accepted from the definition of rental activities. So it's no longer a rental activity. It's treated like any other business would be treated. And in any other business, you're either materially participating or you're not. If you're not materially participating, a business could be passive too. And it's common with like limited partnership investments in businesses, like your pizzeria, like you invest in someone's pizzeria, but they're the one doing all the work and you're just the money partner. That can happen there. So it turns it into a regular business. Then you have to materially participate. So to materially participate, there are 7 tests that you could pass. 3 are most relevant. The first one is you spend more than 500 hours on the activity, and that's it. You're done. Check the box. The next one is you do substantially everything for the activity. So you're a one-person show. You do everything yourself. Maybe you have 1 or 2 people help you very minimally. The third one is you spend more than 100 hours on the activity or on the property, and no one else spends more time than you. And this last one is you meet any of these 3 or any of the 7 in aggregate. In total, you check that box. And by far the most popular one out of these 3 is the 100 hours, and no one else spends more time than you, because it allows you to hire a cleaner, hire handyman to come and fix the property from time to time, and still run the show. So again, to summarize that, if you have an average period customer uses 7 days or less, and then you materially participate, or 30 days or less, but and you materially participate, then your losses on the rental property, on the short-term rental or short-term rentals, are non-passive. Not all of your rental activities, just the short-term rental or rentals that are in question.
Yeah. That brings up 2 more questions. So the first one is, when you talk about those hours, whether we're talking about the short-term rental or you're talking about real estate professional status, how do they know? Like, I understand if you have a W-2 job, it's like, how do I work twice that, basically, to, if you're working a normal 40 hours a 40 hours a week, how do you say, okay, I'm actually working, 81 hours a week, and that's how I qualify? How do you prove it? I assume if you get audited, they're going to want to show something.
Yeah. So by far the way that's been proven to be the most effective at proving your time is by having a time log, like an Excel spreadsheet, or perhaps use a time tracking software like Clockify or something, that details out your time. That's by far the most, it's the most effective as proven by tax court cases. However, if you're in real estate full time, if you're doing this, if this is like this is what you do for a living, you're in it day to day, you probably get away with a calendar, because it'll be very clear from your calendar, your emails, your cell phone activity, everything, that you really are a real estate professional. So, you have to have some type of documentation, either a time log or a calendar. In some cases, it could work as well. Having said that, though, in terms of the W-2 position, it's nearly impossible to qualify, because here's what happens, right? When you have a job, the IRS assumes that you're working 2,000 or 2,080 hours per year, so 40 hours a week. And that would mean you have to work 2,081 hours on top of that to qualify as a real estate professional, get around that more than half your total working time rule. So that's 81 hours per week, every week for the entire year. And the IRS knows that's not sustainable or practical in most cases. So they're automatically going to deny your position for more or less if you have a W-2 job. So and they will go as far as to contact your employer in some cases and say, well, how much did Jason work at XYZ company this year? Your employer is going to give them the records to show you're working 40 hours per week. The IRS is going to say, okay, great, you're working 40 hours here, so you can't be working less than 40 hours. Your employer just told us that. And then you'll have to prove that you worked a total of 81 hours. And only one person was ever able to really prove this, and this person was a boat pilot. And he was able to prove that he worked like 1,000 hours as a boat pilot, had eyewitness testimony and character testimony, and ultimately got it through. But almost every other case that I'm aware of, and we've went through a lot, it's nearly impossible to qualify for the W-2 job, unfortunately.
Yeah, yeah. But it can be one or the other of a spouse. Like if you're a married couple, right? It can be
Yes.
one of them can qualify, and then it is a combination effect.
Yeah. So if you have, if you file a joint tax return, married filing joint, and say spouse A is a high income earner, for example, this is where it's common, doesn't have to be a high income earner though. And then you have spouse B who either maybe works part time or not at all, and they take over the duties of the real estate for the family. If you look at it, if you want to look at it that way, and they can qualify as a real estate professional, then basically the losses from the rental activities will be non-passive on that joint return, and we'll be able to offset the other spouse's business or W-2 income, for example. We see that quite commonly.
Yeah, yeah. I think that as far as that, I think the real estate professional status is almost maybe easier to not achieve, but to define, like yes or no, you qualified for. I think the short-term rental thing, it gets a little bit tricky, probably given a lot of the like local regulations that have changed in places where people have been using short-term, like I'm in LA. I think at this point you can't do a short-term rental less than 30 days. So now if you are trying to use that strategy with short-term rentals, it's essentially now you've got to do midterm rental, and that could probably impact you. So I feel like that's an important thing to understand if you're going to try and sort of harness this loophole.
Yeah, no, absolutely. That's one of the most critical aspects of short-term rentals right now, is just knowing your market and knowing that regulations could be coming up the pike, because New York has similar regulations, in New York City specifically, where you can't do short-term rentals. And there's other markets, and we've seen people who bought short-term rentals in a certain market, underwrote it for short-term rental use, and then the city out of nowhere, or seemingly out of nowhere, came down, either banned them or restricted it to the point where they couldn't do it anymore, and the property didn't pencil out as a long-term rental, or even perhaps a midterm rental, and they were forced to sell, or they're taking losses. So when we're working with clients who are considering short-term rentals, the number one thing we say is like, look, you have to know your market. You want to try to stay out of markets that are residential, where the township might ban it or restrict it, or urban areas like New York City, for example, or LA, that they want that housing. So you have to be careful about which markets you're investing in. Another thing we also recommend often is to underwrite it not only as a short-term rental, but underwrite it as a long-term rental, and underwrite it as a midterm rental, so that if it does get banned or restricted, whatever, you can always have a fallback plan and perhaps still come out in a good place, despite maybe not being as great as it would have been if it was a short-term rental.
Right. Yeah, and that's not to say that you couldn't make money with these properties, but if you're going to if you've got it specifically for the tax loophole, and then the regulations change such that you can no longer qualify for that tax loophole, then that could be you might still be able to make money, you just may not be able to have the same write off. And the other thing that if I'm understanding this correctly, is realistically you would have to get a short-term rental like once a year if you wanted to keep this strategy going, because you're gonna get that bonus depreciation one time on your cost seg, and then you got to do it again the next year if you want the same impact.
No, exactly. This is you're going to get the most benefit in the first year. There may be, depending on the property, how much cash flows, your expense ratio, all that type of stuff, there may be a minor loss in future years, perhaps. But at the end of the day, you're getting that one big loss in that first year, and then that's it. So to your point, if you did want to continue using the tax benefits of the strategy, you would ultimately have to acquire another property every year. So
yeah, and my only point in saying that is if you're going, like, using real estate for tax strategies is a great idea, but you have to actually look at it like, what does it mean, not just this year, but each additional year? Like you're going to have doing it a one-time thing is probably not going to help you in a lot of ways. You may set yourself up with some issues on that specific real estate purchase just to get out of taxes
Yeah.
in that first year.
Yeah, and it's there's you have to go into it knowing that. Our recommendation is for the most part is if you're going to short-term rentals, you should be going to it as a business for short-term rentals first and foremost, and let the tax benefits be the icing on the cake. Because to your point, if you enter a short-term rental business, which is much more challenging to run than a long-term rental because there's high turnover, people come and going, potential for more damage, you have to communicate with guests, all that stuff. You might find yourself in a bad position saying, okay, I didn't really want to be in a short-term rental business. This kind of sucks, for lack of a better way to put it. And we've had people in that situation. And so the bottom line is you don't want to let the tax tail wag the dog. That's what we call it. You don't want to overweight your an investment decision due to taxes. So if you're going to be going to short-term rental business, you want to know that it's a business, it's a real business. And while there are tax benefits, you have to be prepared to run a business on an ongoing basis.
Yeah. No, that's a much more eloquent way to say it than what I was getting at. I think it's just important to understand what you're getting into, and whether that's a active real estate investor, passive real estate investor, that just don't just go in blind. So,
right.
Well, let me shift gears so I can ask you every question, or ask you the questions I like to ask every guest. The first one is based on the name of the show. So I always like to hear, kind of what is your why? What's driving you? You've had a lot of success. What keeps you going?
Yeah. So at this point, momentum. I don't know that I could stop if I wanted to. But like my why, my underlying why. So I read a book, Rich Dad Poor Dad, Think and Grow Rich by Napoleon Hill a while back. And I came up with the chief definite purpose that I want to live the good life, build generational wealth, and help others do the same. So that's my why. Why is that so important to me? I grew up in a lower middle class family. We always had clothes on our backs, food on the table, all that stuff. But we kind of survived. We never really quite thrived. So since I was a teenager, I was like, how can I do differently? And that's kind of what drives me.
Yeah, oh, that's fantastic. I like the momentum piece. I do think sometimes it's like you think about. That's why I think it's so important. Like you can't think of stuff like investing in business and whatever as an end point. It's
Right.
more like you're trying to create a sustainable engine that keeps going, and
Right.
maybe you're needed less and less in that engine, right? But it's still like that. The idea is you're trying to build something that keeps growing. So I like the momentum piece. We're 300 in. No one's ever said that before, so that's pretty cool. Tell us something about yourself that isn't common knowledge. Special skill, a hobby, something to let people know you better.
Yeah, I mean, people probably don't see this ever, but I'm a big fitness guy. I like going to the gym and doing like kickboxing and stuff like that. So I'm big into fitness. I'm big into fitness and being healthy and being in shape. I believe that I'm in my 30s and I feel great. You know what I mean? Like, I attribute, because I know people who are my age, like, oh, I'm old, feel bad. And I'm like, I feel like I'm 25, man. And it's like, it's because of the diet and fitness. I'm convinced that it's because of that. So that's something most people do not probably know about.
Yeah, no, it makes a huge, and I am not in my 30s anymore. And I can tell you it is a huge part of like being able to sustain the activity level and drive that you want is like you said, fitness and diet. And I'm good at fitness. I'm working on being better about diet, but I do love exercise, so that helps a lot.
Yeah, and look, I'm not perfect in my diet. I went on a binge the other day and I ate like 3 bags of popcorn and like 4 things of Reese's. I mean, it happens. It happens.
Yeah. It's the 80-20 rule, right? We want to do it right most of the time. When people hear this and they want to reach out to you, what's the best way?
Yeah, so the best way to reach out to me would be going to thomascastelli.com/links. And the reason why I say that is because if you go to that page, I have all my links, the podcast link, some giveaways and stuff like that, as well as social media. So that's really, at the end of the day, that's the best place to find all my contact information, thomascastelli.com/links.
Okay, awesome. And we'll put all of your contacts in the show notes. final question for you, Thomas. What advice would you give to someone who this question is an interesting one depending on the guest, and you can take it in whatever direction you want. But I always like to ask people, kind of what advice would you give to someone who is starting out? And a lot of times, a lot of my guests are real estate, so, but I don't, if you want to take that in another direction, I'm not sure that starting out in taxes makes a whole lot of sense, but you've invested, you're an investor, and you understand, like I said, from both sides of that equation.
Yeah.
So what would you tell people, kind of starting out in the industry?
Yeah, absolutely. So from the investment perspective, I would say first thing you want to do is you want to get some level of education. So books, podcasts, perhaps different programs, things like that can help get you your initial education. But you don't want to spend too much time in that phase because eventually you do need to take action. And that's one of the things that I failed to do when I first started is like I was operating out of fear or like analysis paralysis, where it's like, I don't know enough to get started. Oh my God, I'm scared to move forward. So eventually you just need to rip the Band-Aid off and take action, because that's really where the learning is going to set in. And look, you can continue your education as you go, but you just need to take action. And if you're in fear of taking action, get around people who are taking action. Like there's meetup groups, there's communities, things like that, and they'll help give you the confidence to go. So if you're just getting started, get your education, but start taking action. And really, what I'd also say is during the education component of it, really get clear, well, maybe even before that, get really clear on your goals, right? Get clear on your why. Why are you in real estate? Why do you want to invest? What do you want to get out of it? Do you want it to be a career? Well, maybe if it's a career or a career change for you, going the active route maybe makes sense. But if you just want it from the investment perspective to diversify your portfolio or get better returns, so on and so forth, perhaps going the passive route is the more appropriate choice for you. So I guess the first thing you want to do is get clear on what you want to get out of real estate and what are you willing to put into it, then getting some education, then pulling the trigger and just getting started. That's really my advice.
Yeah, no, that's great. It's great advice. You need to know something, but you don't need to know everything. So I think it's, eventually at some point you just got to, I don't care how much you study, learn, get mentors, like you're not going to know everything. And so at some point you'll have to kind of take a step forward. So excellent advice. Thank you so much for coming on the show. I think this will be super helpful to people. It's helpful to me. I think I can maybe answer some of those investor questions a little bit more clearly as well. So thank you so much for taking the time out today.
I appreciate it. Thanks for having me.
Yeah. And folks listening, please like, rate, and review the show so we can get more great guests like Thomas. And thank you all for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?